Good morning, Jags. This is Fahad. Today is Wednesday, October 14th. Let's get started. One chart on my watch list that I added last night, and that is Chart Industries, symbol GTLS. Very nice looking technical setup for a breakout over here. If you look at this chart, you will see that this has been consolidating near prior 52-week high within a tight range between 65 and 75. And there is a setup here for this to take out this 7750 resistance. And if it does, we're going to have a new breakout to 52-week high. Yesterday was a very nice hammer reversal candle as well as a bullish engulfing candle. The stock closed at the highs of the session. So I want to see if we're going to see any kind of follow through to the upside today on Chart Industries. Here's another technical look, similar picture, but from stockcharts.com. And you can see this is the consolidation pattern that this has been under between 65 and 75. Here is that beautiful looking bullish engulfing and a long tail hammer reversal candle. See if it starts to take out some of this resistance. MACD and RSI are firmly in uptrend and still have plenty of room to run before they are overbought. And overall accumulation patterns looking at volumes have been rather healthy with no signs of distributions anywhere on this chart. And so overall technical picture looks very, very good. Now, with that said, there is a Bank of America note out this morning that could potentially help this stock. That may lead to a breakout essentially. This company actually has been expanding its total addressable market size by making two acquisitions in the recent weeks. But up until now, no analyst had taken the note to potentially start building that into forward earnings estimates. So, for example, within the last couple of weeks or so, the company acquired Worthington's. That's a different company symbol, WOR. This is Worthington Industries. Chart Industries or GTLS acquired Worthington's cryogenic and hydronic. I chopped that up pretty bad. The company acquired Worthington's cryogenic and hydrogen trailer business at an accretive multiple. This particular acquisition was a small tuck-in acquisition, which will immediately give about $20 million revenue boost to the company per quarter, and then potentially reach to $30 million within the next 2 to 3 quarters. Similarly, the company also announced an investment of 30 million euros for a 4.3% stake in a company called McPhy in Europe. And that company specializes in zero carbon hydrogen production and distribution equipment. Both of these are very strategic acquisitions, and there is a theme that is developing here that I think is worth monitoring. Why is the company making this one acquisition in the US and one acquisition in Europe? It points to management's intent that they want to be positioned for what could be a hydrogen transport in the trucking business, both in the US and in the Europe. Basically, these acquisitions highlight companies' willingness and intention that they see that the locomotive fueling and onboard storage tanks for marine fueling applications that includes repair, service, leasing footprint, and all of that in the future or in coming years will be driven by hydrogen. And as a result, they want to be positioned with just the right type of product mix to benefit from that. The company also mentioned with the acquisition of Worthington's tuck-in acquisition, they also signed an MSA to store and transport liquid hydrogen for PLUG, as that company is building out 100 customer-facing hydrogen fueling stations across the country. And lastly, if we actually look at the presentation that the company gave in late August, that's available right on their website, a big giant presentation. They talked about how these acquisitions will expand over the next 3 years the total addressable market size within the hydrogen markets from 500 million to 1.1 billion dollar. Presumably almost doubling the $100 million in synergy in hydrogen revenues by 2023, according to the company alone. They also talked about that 10% of the revenues by then will be coming from the hydrogen business versus 0% today. For perspective, this total addressable market size assumes just 136 fueling stations to be built by year 2023, and the company will generate $1 to $2 million in revenues per station. However, if you look at, there's a separate large research note out from McKinsey and Company, and they talked about that as many as 1,000 fueling stations for hydrogen for truckers will be built in the United States by 2025 alone. So the company, despite increasing its total addressable market size in the next couple of years and talking about revenues that they will see fresh new revenues and hydrogen becoming 10% of the total piece, they're still basing that on very, very low estimate of only 136 fueling stations versus McKinsey believes it could be as high as 1,000. So I think the opportunity is there in out years. And these acquisitions were only announced in the last couple of weeks or so. Chart sets up for a breakout. I'll be monitoring any kind of option activity in this name going forward from here as well. See if we have more upside and this gets to above $80 to $85 per share. That's it from me. Jay?
Morning, everyone. Today I wanted to highlight Autodesk, symbol ADSK. So this is a leading provider of computer-aided design, or CAD, software for the construction, manufacturing, media, and entertainment industries. Essentially, it allows customers to digitally create things and bring them to market more quickly. Last time we mentioned this stock was on August 19th in the chat room. Fahad, you pointed out a bull risk reversal in which over 2,000 January 210 puts were sold to open, while 2,000 plus January 260, 290 call spreads were bought. It was done for net credit. And this was about a week before their earnings report. Now, those are still in open interest, and Stifel was out with a note last night following investor meetings with both the CEO and the CFO. And it was about a 3-page note, and a handful of topics were discussed, but some of the key takeaways, in my opinion, revolved around infrastructure being one. Autodesk has not quantified the size of its infrastructure portfolio within its AEC segment, which is architecture, engineering, and construction, but they do note that infrastructure represents a quote-unquote sizable component of the portfolio, and that infrastructure growth is very similar to overall AEC growth rates. And so regardless of the outcome of the presidential election, the company believes that future stimulus programs will be enacted that will include a focus on infrastructure spending, which in turn will provide tailwinds to the AEC segment. Also, they talked about paying clients. Several months ago, the company made a number of their products free for commercial use, and then as well as extending payment terms for paid products, essentially to assist customers during this pandemic. They didn't disclose any actual numbers, but it did see a healthy uptake of these free offers. So there is, needless to say, an opportunity to convert these free users into paying users. Another topic they discussed was the cloud. They believe COVID-19 has accelerated the opportunity for a shift to cloud-based CAD, which in turn, they should begin to see a healthy demand for its Fusion 360 platform. At their analyst day back in June, the company disclosed that it had 85,000 paying users for Fusion 360. And then in Q2, they announced they added another 10,000. So ultimately, this should continue to gain some steam. And then the last point I want to make, and something I did not know, investors wanted to understand more about the relationship it has with Unity Software, which we just talked about on Monday. Unity and Autodesk have been partners for a couple years now, and they've been sort of the engine underpinning the 3D immersive AR VR visualization. And this has largely been taking place on the AEC side, but in the future, they believe they can expand this partnership to also bring it to the manufacturing side of things. So a really good note, lots of interesting topics. But yeah, I think something to be excited about going forward for this company.
Yeah, there's a lot of tidbits over there that all point to pretty positive momentum for the company, and I think that's what matters the most. The only thing one thing I will point out is that, and this is positive as well, this company tends to have a very high correlation with the architecture billings index,
Sure.
because naturally that the industry that the company serves, basically they're all tied to be the core, core economic changes and such. Architecture billing index provides a lot of forward-looking commentary in terms of design contracts, the index, and the regional movements and all this. The last reading that I have of ABI came out on September 23rd. And so for the month of September reading, they'll probably come out within the next week or so, but we don't have that yet. But if looking at the August Architectural Billing Index, project inquiries index rose to 51.6 versus 49.1. Design contracts index rose to 46 versus a month ago it was 41.7. So a huge increase in design contracts, and I'm assuming that plays directly for the benefit of Autodesk. And if we break that number down by regional averages, we will see that Midwest was a strong, South was a strong, West was a strong, only Northeast was a little bit weak. And further, if we break it down by sector, we will see that overall, pretty much multi-residential, commercial, and everything else was quite actually positive, trending in the right direction. So all of these things are positive for Autodesk. Just a high-level view of how it's highly correlated to ABI index. So interesting one. Okay, fantastic. And I like the technical setup too, with that large bullish risk reversal position in January, something we need to keep an eye out before the next earning comes out. Maybe there's a setup here for a breakout through 255 to 260 and then eventual 280 plus in the next coming months. Great stuff. Before I go to Chronicle, I do want to point out, because this is a very out of the box note that just came out. I don't have the full note in front of me, but I'm going to look into it. But in the last couple minutes or so, apparently Oppenheimer analyst made a case in a note that they believe that New York could legalize sports gambling by the end of year. Now, this would be huge if that happens, but I honestly don't see the chance of that happening. I think it's very low chance, and how they're going to move with the expedited fashion to get this thing done by the end of the year, if there is any progress at all. And if you look at all the street estimates that are out there for DraftKings and Penn National Gaming, New York isn't even expected to legalize until 2023 or maybe even later. So nobody has it in their models yet. So I don't know what basis Oppenheimer analyst is using to suggest that sports betting could be legalized in New York by the end of this year. Anyways, I just wanted to point out, see how the stock reacts to this, DraftKings that is, when the market opens. Chronicle.
Morning, Fahad. Have a refresh of the long MAA short BXP pair trade that we recommended back in early July.
Yeah.
And I guess this can also apply to one of the trade ideas in our latest quarterly outlook. So Morgan Stanley was out with a note with channel checks showing divergences between rent growth in the metro areas versus the more suburban Sunbelt areas. Basically, this is everything that we predicted when we put out that pair trade. First off, and most importantly, Morgan Stanley found that seasonally adjusted rent growth has declined to 2 full percentage points below the average since 2015. They declare that the worst performing areas are New York, San Francisco, and Boston, with concessions being a headwind when it comes to new leases. Secondly, their checks are suggesting that households have chosen to leave more densely populated urban areas in favor of the Sunbelt suburbs that Mid-America operates in. And between Q1 and Q3, less densely populated cities have seen year-over-year home prices accelerate from 4% to 5.6, and the suburbs have also seen acceleration from 3.6 to 5. But meanwhile, the large metros are not seeing any acceleration. Now, even though Boston Properties is more of an office and commercial REIT rather than residential, I think this is a damning read-through for them because recall their biggest markets are New York, San Francisco, and Boston. And if we look at these graphs here, these are places that are being hit the hardest in terms of income and jobs. This tells us that there's some serious downsizing going on. So we have to assume that Boston Properties is going to get affected. And if we look at the main bullish arguments for Boston Properties, it's basically down to three things. Number one, stock is cheap. Number two, dividend yield is attractive. And number three, Boston Properties tenants are mainly high quality AAA companies. So the first two arguments, cheap valuation and high dividend, at Jaguar, we tend to prioritize capital gains rather than dividends. Like as traders, there's not much point in collecting dividends, having to pay taxes on them while watching the stock remain cheap for years. If we pull up the chart of Boston Properties, even before the pandemic from 2015 to 2019, the stock went nowhere, stuck in a range because this company barely grows. So there's a lot of opportunity cost to having capital trapped up in the stock like that. It's not hard to find something else that's going to appreciate more than the dividend yield, even after risk adjusting. So that's what I would say to the first two arguments. Now on to argument three regarding the high quality tenants. The thing is, these behemoth tenants have been allowing people to work from home deep into next year. We're talking around middle of 2021. And these tenants have a lot of negotiating power. If Google or Salesforce, Biogen, or BFA were to suddenly ask Boston Properties to reduce their rent or make concessions and modify contracts, it's not as if they can easily say no to their biggest tenants. So having AAA tenants is kind of like a double-edged sword. I mentioned this because Boston Properties has 26% exposure to tech companies with majority in San Francisco. And in our latest Jaguar quarterly outlook, we did cover in detail about all the problems going on over there right now. These tech companies are extending their work from home policies all the way into Q2 and Q3 of 2021. But the thing is, if companies are telling workers they can work from home for more than a year now, chances are at some point they're just going to give them the option of doing so permanently, just like what Microsoft did earlier this week. And so I think only a fraction of tech workers are going to come back to the office, while the rest will opt to continue remotely. I've also seen recent articles about New York City landlords trying to guilt trip companies into bringing back their workers. That's not a good sign, tells me some panic going on. And then this morning in the first read, there's an NYT article talking about how 73% of surveyed workers are reluctant to go back to the office. And then just below that, in the other headline section, we can see that New York City issued $150,000 in fines over the past weekend because of social distancing violations. So putting everything together, there's not a lot of incentive to return. So coming back to the pair trade, we can see from the ratio chart that I shared, this trade has worked out nicely so far. So basically, if you bought MAA common and you shorted same dollar amount BXP, you've made money while at the same time not having to make a call on the overall market direction and the direction of the REIT sector. And I think this trade will continue to work out in the medium term. I think MAA can get to $140. And as for BXP, the stock was cheap at 100, it was cheap at 90, and no doubt it's cheap now at 80, but I can see it eventually trading even cheaper in the mid 60s where there's some long-term VOP support coming to play. So this ratio spread could potentially approach a two handle.
Excuse me. Exactly. I was just about to say, for those who do not remember or didn't see the video, please note that this pair trade was issued on July. I remember where it was, July 8th. This was in JaguarMedia presentation right over here. And basically the trade was to buy Mid-America Apartments, symbol MAA, and short Boston Properties BXP. So that was the pair trade, and this pair trade is up 10%, a little more than 10% since that position was entered. And you can look at this chart in absolute terms as well, where if you just pull up MAA, you can see that this has performed far better, and more recently actually has started to break out, forming a bull flag over here, while BXP on the other hand has been in a steady decline, and there's a potential threat here that is going to break down rather pretty soon and make a new 52-week low. And that goes back to the ratio chart that Chronicle pointed out over here. If you simply do the ratio chart of this pair trade, you can see that it has performed rather pretty good or since that video was posted. So excellent work over there, Chronicle. I think that Microsoft news that came out last week about making employees work from home permanently, I think that's just telling you a lot that you need to know about Silicon Valley. This is not just a temporary hiccup in Silicon Valley, in my view. I think this is a permanent damage that is taking place to commercial REIT, and as well as the urban residential locations where the incentive is simply not there to be in highly expensive areas when you can work from home or really any place. And there's a structural shift that is taking place that's going to have lasting impact for many quarters to come, potentially years to come. And that this means that some of these companies like BXP will have to basically reorganize their portfolios. So I wouldn't be surprised if you're going to see some sort of shedding of assets or restructuring and other announcements in this company over time. But for now, these charts continue to act very weird, and BXP is basically heading straight down, potentially to new 52-week low. So great stuff on that one, and thank you for the update. All right, folks, that's it from us, and we'll see you in the chat room shortly.